Investors Chronicle.
Welcome back to the Companies and Markets show. Delighted to be back. It's Wednesday, a rare Wednesday afternoon recording, which means that we're actually missing out on the regularly scheduled cake trolley. So we're doing that for you, listener.
Yep, this podcast comes at a cost.
It's the most animated I ever see, Dan, when that comes out.
I think it's unedifying, the cake trolley. It's got out of control. There's just the pylon is.
Yeah, I can't deny any of these comments. Yeah. Anyway, we digress.
We digress. Actually, I'm wondering now if that's why Dan was a bit late to this podcast. Anyway, joining us, as you've already heard, over the line we've got Alex Newman. Hi, Alex.
Hi, John. How you doing?
Good, thank you. Julian Hofmann as well. Hi, Julian.
Hey there, John.
And Mark Robinson as well. And then in the studio, Dan Jones. Dan, what's coming up today?
Hi, John. Yeah, we have a bevy of different topics today. We are starting with the supermarkets, with Tesco specifically. Its results this morning, just looking at what more we can glean about the currently quite dismal fate for the UK consumer and how Tesco is holding up in amongst that. Then we'll be looking at our cover story this week, which is also on a consumer favourite, Coca-Cola. Alex Newman has looked at the bull case and the bear case for the company as a bit of a demonstration of how to analyse pluses and minuses for a particular stock. And finally, we are returning to the big macroeconomic story of the moment, rising interest rates. And we're looking at those from a corporate perspective, and we're going to be discussing some of the many ways they might impact UK PLC over the months ahead.
Before we get into the show, a quick news roundup as usual. The new car market recorded its second successive month of growth in September, with registrations up 4.6% year on year. And sales of electric vehicles continued to rise. More than 1 in 5 new cars registered were either battery or hybrid vehicles. However, overall registrations remain well below pre-pandemic levels. Real estate agency Knight Frank has predicted that house prices will fall 10% over the next 2 years, becoming the first major broker in the UK to forecast a double-digit downturn. Minor Anglo-Pacific Group is changing its name. The company will now be known as Ecora Resources. It comes as the company pivots away from coal towards metals associated with the energy transition. Greggs like-for-like sales were up 15% in Q3 as it maintained its full-year expectations. They've also opened 90 new shops so far this year. Shares rose 10% on the news. Telecom Plus shares rose 18% on Monday as the utilities company profits from the energy crisis. Telecoms Plus bundles services across energy, communications and insurance and has seen 86,000 customers acquired in the first half of the year. Shell stock, on the other hand, plunged 5% after a trading update said Q3 results would be, quote, significantly lower than Q2, blaming a volatile and dislocated market. Profits for Q2 were £3.4 billion. And Made.com have said they hope to see bids coming in this month for the business. The furniture retailer has seen a market valuation crash from over £600 million to just £16 million. And finally, the Bank of England has now stopped buying government bonds for the first time since its emergency intervention to stabilise the market. That's all from me. On with the rest of the show.
Thanks, John. Yeah, so Tesco, to begin with, its results this morning as we record on Wednesday. You know, the company is under pressure, but at the same time, it seems to be holding up relatively well, is my, potted summary. Mark, is that a fair assessment, do you think, of Tesco's position right now?
Absolutely accurate there, Dan. I guess in many ways, the shares came off slightly on release this morning, but I don't think it would have really surprised anyone. On the plus side of the ledger, the volumes have held up, as has the firm's market share. In fact, we a few months back, we looked at Tesco from that perspective as well, because Kantar had put some data out which showed that it had increased its market share, albeit marginally. But the significant point there was that this was the first time in 6 years that it had done this. And it was also fairly clear at that point of the year as well that management was trying to get out ahead of the inflationary spiral. I mean, prices were already rising by the end of the first quarter, and indeed before that. but they'd taken concrete measures, expanded the share match program they've got as well, and I think, as you talk about in a moment as well, the loyalty schemes have proven to be very successful. I was. Scuttlebutt's a sort of a useful thing with the supermarkets at the moment, because I was discussing them with a friend of mine, and she's got a couple of young kids, and I just asked her, have there been any changes to your sort of consumer habits? And she said yes. Well, she started going to the German discounters, not for fresh food, but for the store cupboard items, and I think we're going to find a lot more of that as the year progresses. It shows that the main determinant for the grocers is the duration of the inflationary period as well, because they can deal with sort of contracting profits for a certain length of time, but they're going to get to a point eventually, and perhaps some of them got there already, where they can't pass on costs anymore, else consumers will invariably trade down.
Yeah. And we see, I suppose, just to set the scene a bit more, obviously, the supermarket's point of view coming into this year, they wanted to avoid the mistakes of a few years back, the last time we had a bit of inflation, albeit not the same level we have now, where the discounters really ate into market share. To an extent, that has happened again, as per your conversation just then, Mark. I think it was just a couple of weeks ago that Aldi overtook Morrison's to become effectively one of the big four for the first time, or at least for the first time in a while. But from Tesco's point of view, it does seem to be holding up quite well, even with regards to that. And as you say, the loyalty factor, the loyalty scheme seems to be crucial here. And this is something that the retailers outside of the UK have done for, several years. They've used, in Tesco's case, the club card scheme. Other retailers have used their equivalents to offer discounts for those using the club card scheme. And this seems to work really well from Tesco's point of view. The club card numbers are really soaring, and that can obviously offer greater analytics insights in future as well. And it gives them a way to, keep price increases down to a certain extent. And, it attracts the consumer. You feel like you're getting a good deal, don't you, when you see the big difference?
Yeah. I don't think they've got a great deal of room to maneuver as well, because if memory serves me, I think Tesco last year were trading on a net margin of 1.3%. So, firstly, it leaves you wondering how the German discounters managed to sort of push it down any further than that.
With ruthless efficiency.
Ruthless efficiency, that would be it. That would be it. I guess a point as well is that Audi or Lidl, neither of those companies offer a home delivery service, although I think Audi may have had an arrangement with Deliveroo at some point. That's a factor. In March of this year as well, the bosses at Tesco were evaluating exactly what happened in lockdown and the changes to consumer behavior there, because we had sort of various dynamics. People were obviously eating a lot more at home, cooking in-house. And so they've probably had to question since then, or try and evaluate what has become hardwired behavior for consumers. But eventually, it just boils down to price in an inflationary environment.
Yeah. And I think I should clarify as well that the thing that Tesco are doing differently now is, they're really, you go into a Tesco now, you see the price, and then underneath you see the club card price, and there can be some big differences in those cases. Alex, I think you had a point to make on loyalty schemes.
Yeah, no, it's just a more sort of general point on value of these loyalty schemes. It's one thing to point out is that it's something that all the supermarkets do now. It's kind of standard operating procedure to have this scheme. I'm also just not really that convinced with the data supermarkets have on their customers is nearly as important as it seems from an investor's perspective. I mean, it's really important to the supermarkets to understand or have some oversight of the shopping habits of their customers, because it means they can plan and target. But I mean, the dynamics of the sector are such that, any efficiency or margin gains from this data is basically imperceptible. I mean, Tesco's shares down today on their interims. They're down quite heavily over the last few months. Long term, they're down even more. It's not, having this data doesn't make the UK supermarkets a Google. It's not capped information they can sell them to third parties in the same way. So I think, these club cards have been good initiatives for kind of like pulling people in a little bit, but everyone does it. I don't really know what the edge it necessarily provides in terms of expanding or growing the business.
As first principles, maybe Jack Cohen had it right all those years ago. Pilot high, sell it cheap.
Yeah, and I think I was listening to some of the management call earlier, and Tesco, they, obviously these schemes do lend themselves to big pronouncements, but as you say, the proof will be in the pudding or otherwise. Whether there actually is going to be any impact on, bottom line is quite hard to discern at this point. I think they talk about things like, personalised promotions and things like that, but as you say, how much that moves the needle is really up for debate, to say the least.
Certainly worth a look. I mean, Chris, the stock itself, Chris Ackers this morning pointed out they've got a forward rating of 10 times earnings, and they're trading on a forward dividend yield of nearly 6%. So it's certainly worth a second look from an investment perspective.
Well, you do have to wonder, though, whether that isn't heading towards value trap.
Yeah, I agree. I think it is a value trap.
We know that there's big headwinds coming for the consumer. It's probably quite hard to see a catalyst in the near term, but at the same time, it strikes me as similar to Next. We discussed briefly last week, Mark, off the podcast. But, a well-managed business which is coming in the bottom end of guidance. Next brought those down a bit, but those structural headwinds are quite hard to get past in the short term. But maybe some value there, longer term. Opinions differ.
Oh, every little helps, doesn't it, Dan?
As someone said, yeah. Well, I wanted to actually pick up one other thing before we move on, because it does segue in nicely as well. Another line from results call summed it up really. Tesco chief exec saying, we see customers prioritising value wherever they can, which, doesn't sound that surprising in the context of what's going on. But I wonder what that might mean for, the consumer staples, really, the companies for whom brands are still very important. We've got, Unilever, for example, reporting at the end of the month. Last time we heard from them, again, they were managing to pass on prices quite well. They hadn't seen much transferring down, but the situation's only got tougher since then. And you do kind of wonder how much the price sensitivity of everyone right now is really going to rub up against the marketing share, the marketing they have and the market share they have.
Well, I think we'll probably come back to that as well, because a week prior to Unilever releasing those quarterly updates from both Procter & Gamble and Nestle as well. Mm. So we'll certainly get some idea then. And, I guess one of the salient points is, will people be going over to generics? We've seen it in the past. Is brand loyalty is still as important as it used to be? There's will be quite a few interesting questions. I think we could possibly come back to it later in the month, I think.
Yeah,
I could throw some scuttlebutt into the hat while we're at it. I mean, I'm a recently sort of converted back to Lidl for price reasons. So I'm probably the kind of person who's getting picked up in the Kantar World Panel market share shake-up, sort of transferring from Morrison's to the German discounters. But I noticed the other day, Heinz tomato ketchup, £3.49, and the slightly smaller but Lidl own brand version was 59p. And sort of think, yeah, I'm a big Heinz tomato ketchup fan, but I think when you're presented with stark differences between the sort of the brand staples and the own brand, it kind of goes away to explaining why, over the last decade, the share of the German discounters has gone from 6% to 16%.
I think I would foresee an even more radical future. I mean, if you go over to Germany, there are no supermarkets other than Lidl or Aldi.
Is that so?
Well, pretty much. And you kind of think, well, it is ruthlessly about the price. And obviously, like you, Alex, I buy my olive oil at Lidl these days. And yeah, it does come down to the value. We've got a Waitrose up the road, but we don't bother going there. We just go down to the local Lidl.
Alex, isn't the reason that you went to Lidl initially was for much the same reason that you go to the Tate Modern, because of the displays they had in store, the sort of seemingly anomalous products? This is what you told me ages ago.
Yeah, I mean, middle Lidl is still a wonder to behold. I don't buy from it, but yeah, that has a modern art quality to it.
Yeah, I think you mentioned Waitrose, Julian, and one thing that strikes me, if we do get more pressure on higher income or middle income, from say rising mortgage rates, whether those kind of people might shift down to a Tesco or whether they would just go all the way down to the discounters, we'll see. I do also know actually on ketchup, because I specifically went to Tesco to buy ketchup the other day, that their price was £3.30, which obviously struck me as very extreme, but I suppose that is slightly cheaper than the Heinz ketchup in Aldi and Lidl, which shows they can negotiate better prices with Heinz, but they still can't really compare to the the store's own version, as you say, which kind of sums it up, I suppose. Anyway, let's move seamlessly on to another big brand. As we mentioned at the top, Coca-Cola, one of the most distinctive brands in the world, if not the most distinctive. I'm just, spitballing here, but I imagine so. Our cover feature this week, though, Alex, you've written about is really a deep dive into the drink, no pun intended, and into how one analyzes a share, both the positive and the negative, the bull and the bear case, if you will. So why don't you maybe just sort of talk a bit about what kind of inspired this and what kind of things you were looking at in that piece?
Yeah, I suppose what inspired the piece is that I find this really, really Coca-Cola company that is US listed, parent company of all the sort of Coke branding and operations. It's such an interesting company because it is clearly has the hallmarks of a quality stock. It has this huge 140-year history. The brand power that you alluded to there, I think after technology companies, it's very slippery to evaluate the value of brand equity. But after technology companies, it is, I think, widely seen as having the most valuable brand IP in the world. And yet it is operating in a market that is incredibly mature. It sells soft drinks. It's not reinventing the future. And where the investment case sits now with what you might expect to come of a company in this kind of market, for me, is a very, very hard one to work out. So it was almost kind of a thought exercise. Yeah, I suggested doing it as a kind of bull and bear case, and I probably unsatisfactorily don't come down on either side at the end. But yeah, that was kind of the inspiration behind one like this.
And there's a lot to pick up there. I mean, as you say, even in terms of how we name the company, its operating model is quite interesting. We'll come to that in a minute, or maybe we'll come to it right now, because I wanted to talk about as well, the fact that Coke itself is, less than 50% of the company's sales. It's very much about finding new products, finding acquisitions that can keep it going, keep that narrative going. And there are various interesting ways that the business structure allows it to do that.
Yeah, absolutely. So, Coke, when you say Coke being just under half sales, that's Coke, I think Coke trademark products, so everything else, so Coke Zero, Diet Coke, etc. Yeah. So it has diversified into all these other beverage areas, be it energy, other energy drinks, fruit juices, bottled water, etc. But the company structure and the way it operates is kind of the secret recipe really to its success. Rather than, its US operations are slightly different, but when you're looking at the global company, rather than sell directly to consumers, what it mainly involved in doing is the sourcing and production of concentrate and syrup for its drinks, which it then distributes to licensed bottling partners. So they add the water, other sweeteners at production hubs near to where the drinks are consumed. And in that sense, it's kind of like a platform company, slightly loath to use that word, but that's sort of one way you could pitch it in that it kind of licenses a product which it produces for very low cost, and it removes itself from the most capital intensive parts of the value add chain. So the logistics of getting the finished products to the consumer, the quite labor and capital intensive job of actually finishing the projects, which requires enormous resources and manufacturing capacity. So what it's done is it's basically extracted itself from all the lower margin stuff, created these symbiotic relationships with bottling companies around the world, and kind of parked itself in a sort of position where it earns gross margins of about 50%, returns on equity, consistently over 40%. And it's just wildly profitable, much, much more profitable than its bottlers. And, that's why it trades on, such a heady valuation. But yeah, as we discussed in the piece, I think there are some issues with this model and kind of limits to why it is necessarily a good thing.
And I suppose one of those right now is, when your sales growth is, this is a mature product. Okay, it's got various developing markets to sell into, but nonetheless, most people by now will have heard of Coke and certainly the main offshoots. But it's also fighting inflation right now, cost increases in all parts of that chain, which makes things more difficult, as they do for everyone at the moment.
Yeah, and I think most of those kind of cost headwinds are borne by their bottling partners. The way that both the company and its partners manage this is the Coca-Cola parent company can raise prices. So in the second quarter of this year, they reported 16% organic revenue growth. So that was down to about 4% sort of growth in sales and 12% from price inflation, which suggests that they're very good at passing on, or they have been at least in the past year, being able to meet the challenge of inflation and passing on higher prices to the consumer. But yeah, I mean, managing that going forward, they're not going to be able to raise prices every year, and also the tension that sits in this operating model is how well capitalized and on what kind of margins that the bottling companies can operate on. And it's all very well and good having a franchisee model that means you can earn these fat margins, but when there are problems with your counterparties, you can't sort of escape those issues coming back to haunt you. So no, not necessarily any problems immediately on the horizon, but longer term, looking at things like water scarcity and just general cost inflation, you could imagine that life's going to get a bit harder for some of the bottling companies, and therefore for Coca-Cola Company.
We do talk a bit about some of the bottling companies in more detail in the piece. There are a couple of UK listed ones there as well. So if this has piqued your interest, do pick that up. The other thing I want to ask about is, this is a very interesting case study, and as we've discussed, you look at the bull, the bear case. I suppose it's just interesting from a behavioural point of view. I mean, this is something I discussed with Dan McCrum on our recent interviews podcast about Wirecard and short selling, things like that. Making those cases when you hold the stock can be quite difficult behaviourally to, of course you can look at the positives, but weighing them against the negatives can be quite a hard balancing act to do if you're already in the stock. Is that a fair thing to say?
Yeah, absolutely. I mean, it kind of goes back to what I was saying at the start. I mean, it's often said that of quality companies that the best strategy is to kind of buy them and forget about them, because they're gonna compound over the years. And we should say, I didn't talk about before, that there are ways that Coca-Cola can grow. It can recycle its enormous intangible assets back into creating new products or into parts of the beverage market where it can extract efficiencies and synergies. It's not a zero growth story, but for the main part, for the most of its sales are in incredibly mature markets where there's just it's just harder to see the growth ahead being anything comparable to its history. So I don't think it's going to prove a disaster of an investment case over the next decade. But if I was holding Coke, I would struggle to see whether the quality features of the company are going to outweigh the growth prospects. And that begs the question: is the quality over reflected in the valuation, which asks quite a lot of sort of future cash flows. So yeah, I'll finish by sitting on the fence there, but that's kind of the dilemma, I think, behaviourally that investors can face with a company like this.
Yeah, as I said, that is the cover story this week. So for the detailed discussion of all these issues, do pick up a copy. Mark and Julian, any thoughts on Coca-Cola before we move on? Any strong opinions?
Well, I thought it was amazing that Alex managed to get through it without talking about Warren Buffett, which is an immediately positive start. But he's right. If we're looking at a generally low growth future, which you could make the economic case that we're entering into a kind of cyclical stagnation, is that going to reflect in how companies like this perform in the future? I mean, we only really know the growth of the company from its kind of post-war success, and it's not a given that will continue in those same terms. So I think Alex has asked a very searching and sensible question there. And I mean, my view is that you can't go wrong with a brand. I mean, but do you want to pay for it? That's the question.
Also, like M&A could be a route through to growth as well.
Yeah, it does, like the odd acquisition, as we have touched on. Well, that does bring us on to looking at growth stories and quality stories and companies in general and how they will go in the future. The immediate future, in the UK at least, is one of higher interest rates. And not just the UK, of course, but it's very much on the minds of everyone at the moment, given what's happening in the mortgage market. But Mark, you've written this week from a corporate perspective on some of the things to watch for when it comes to rising interest rates in terms of the earnings piece.
It struck me that with some of our younger readers or listeners, they wouldn't have seen a situation like this before, because we've had a period of over 10 years where we've had ultra low interest rates at certain times, relatively low inflation too. And so when they've come to weigh up their investment decisions, they haven't really been asked to look at the interaction between interest rate bond yields and equity valuations too. And I guess with the situation that it's playing out at the moment, again, I go back to this point: the critical area is going to be the duration of this period of elevated interest rates too. There was a lot of hyperbole in the press last week in relation to the mini budget, I thought, particularly when you look at interest rates from a historical perspective. There's other, I think in last week's podcast as well, we spoke about savings levels and we mightn't see the same level of distress throughout the economy.
Another thing you talk about, if we just talk about it briefly, because I do want to come to debt burdens in general, but another thing you look at is IPOs, the kind of the case for and against. Obviously, it's a pretty dismal IPO market, or non-existent anyway right now, but there's kind of two sides to that coin.
Yeah, there is. I mean, theoretically, at least, when falling, or sort of rising interest rates, rather, it acts as a disincentive in terms of just like borrowing that we've seen in recent times. And I was thinking here of like private equity in particular. Higher interest rates, they provide an incentive to tap public markets because I don't think that's the reason why we've had this slump in IPOs, particularly in the UK over the last 18 months or so. But we're just going to have to wait and see. I was looking around this morning for some data on private equity and the level of leverage there at the moment, but I couldn't come up with anything that was particularly meaningful. But by the same token, all the companies have been putting their listing plans on ice. I mean, that much is fairly obvious, but that might have been exacerbated by the fear of inflation and the subsequent rate rises as well. So it's a sort of it's one side of the coin and the other, really.
Yeah, that private equity piece is interesting because, as you say, private equity costs are going up as well, which are quite important to them in terms of how they work the numbers. Strikes me, we spoke last week about the weaker pound making the UK more attractive to overseas buyers, but given what's happening with interest rates, it might be that the private equity buyers are on the out somewhat, and maybe they're looking to get out of some private companies and make a profit by listing them as well, albeit perhaps a couple of months down the line.
Yeah, I really did try hard to try and get some data on that as well. So I've got no idea how someone like KKR would go about financing these deals as well. I mean, they're short-term arrangements for the most part anyway. They just want to get in and get out as quickly as possible. So yeah,
I think you have seen in recent weeks as well, though, companies who, if you do a debt-assisted takeover, you've got to issue some debt afterwards. High-yield debt in a lot of cases. We saw, I think, with Citrix, that those bonds issued in relation to that deal have been really struggled to get away. So that could, send a chill through people looking to do the same in future.
Indeed, and I finalised the remarks as well with the obvious danger, and that's for interest rates, and that's to liquidity in the market. I mean, that's sort of playing out already, but that's a given, really.
Yeah, so we are. Yeah, obviously we're going to keep a close eye on these things as we tend to do. The final thing, perhaps, to say on this whole subject is in many ways the most obvious one is companies with big debt burdens, and more pertinently companies with debt rolling off in the short term as well. That is something suddenly which is a consideration that will be worrying some people more than others.
Dan sent some data through this morning as well, and I had a look through it as well. And based on that analysis, the UK market mightn't be as badly exposed as we think. A lot of the debt itself, beyond lease liabilities, falls over the medium to long term. So it goes back again to this point of over duration of a rising interest rate period.
Yeah, I think as you say, it's not going to derail the investment case in many cases, but it might just take a little bit off here and there. The flip side being, if you're a company with a lot of cash on your balance sheet, you can refinance and get a lot high margin on that at the moment, which could provide a little bit of an uplift in a difficult time.
Well, exactly. Yeah, yeah. This is not an unusual time that we're in at the moment. I mean, the base rate is still well below its long-term average. It's just that people haven't been, or many investors anyway, haven't been used to this environment and having to make assumptions linked to interest rates and bond yields.
Yeah, it's a new world for some people, but as you say, the real question is how long this period lasts, and the Bank of England will have something to say about that, and we will have something to add to it, I'm sure, as well, as and when these decisions are made. So do keep listening and reading the Investors Chronicle for more on that. But we have come to the end of our time this week again, so thank you to John and to Mark and to Julian and to Alex, and thank you to you for listening. We'll see you next week on another Companies and Markets show.